So when you talk about the cash benefit, we say that the cash benefit, these are benefit that employees, these are benefit, we call it benefits that the employees, we say get from the employer, get from the employer, get from the employer. We call it in form of cash. So these are basically benefits that an employee gets from the employer, basically in form of cash. Are we together? And to say that they're basically taxed as follows. We say that they are taxed. They are taxed. We say as follows. They're basically taxed as follows. They are basically taxed as follows. So number one, we talked about the main employment income. We talked about what's called the main employment. We call it the main employment income. What we call the main employment income. So on the main employment income, we basically say we say they include salaries. We have salaries, we have the wages, we have leave pay, we have the bonuses, we have commissions, we have the commissions, etc. So the first point that you need to understand is that they are all taxable benefit. Number one, they are all taxable benefit with exception. They are what we call the taxable benefits. They are what we call taxable benefit, except, we say that except what we call people, we call it with disability, except people with disability. And what did you say about people with disability? Except individuals with disability. And what did you say? We say that the first shillings, we call it the first shillings, it's enough space, 150,000, where the first shillings, 150,000, is exempted from tax, is exempted from tax on what you call salary, on salaries and wages, where the first shillings, 150,000, is exempted from tax on salaries and wages together. So the last time that this question was particularly tested, that was about 2017, 2016. This was the last time that this question was basically tested. If you look at the time that this question was basically tested in PFT, this was basically tested around 2017, 2016 So it's an area that needs to be looked at. It's an area that definitely needs to be looked at together, team. But for ATD comes, what is taxation in relation to people with disability? Can be asked. You know that the first 150,000 per month is exempted from tax. Respond to the yes if we are together. Are we together? Perfect. So then we went to what's called cash allowances. Cash allowances. So when you talk about the cash allowances, we basically say they include. We say that they include cash allowances. We say they include what's called the house allowances. They include the house allowances, hardship allowances, hardship allowance, we have traveling allowances, traveling allowances, and what you call, and the per diem, we just say per diem, etc. So there's a concept that most of the students, a lot of times, most of the students, they will say that all cash allowances are taxable. Is that true? No, that statement is not true. There's a statement, and it was particularly tested, I think, on HED, the last sitting. That was the HED and the CAMS examination. Is it true to say that all cash allowances are taxable? Is that statement true? Is that statement true? That all cash allowances are taxable? It is not true. For the per diem, we say that it is not true, and majority of the HED students did not pass that particular question. So they are taxable. They are taxable. We say that they are taxable, benefit, except. We say that except per diem, except the per diem, except the per diem, except what's called the per diem. So what we call per diem is called subsistence allowances, where we say where the first, we say the first shillings 2,000 is exempted from tax, where the first shillings 2,000 is exempted from tax. So what is the per diem? What is the per diem? What is the per diem? So what is the per diem? What is the definition of per diem? You know, these amounts that are given to employees for their upkeep when they're on official duty altogether. However, we say that for the finance bill, that is 2025, yes, out of work station, perfect. However, we say that for the finance bill, that is 2025, 2026, what is it projecting? 2025, 2025, 2026. What is there in that document? The per diem is the one to raise it to? How much? Per diem, the one to raise it to? Per diem, the finance bill for 2025, 2026 to 10K? 10K altogether. Then I want to teach you something about tax altogether. You see, tax will always change. This one is what changes very fast altogether. Tax particularly will changes very fast altogether. Sometimes people go to court and find whatever was there, it goes down altogether. So how does those questions present themselves? For example, such a question is a trap. How is it a trap? You can be asked what are the changes, though it will not be asked in a usual question. The usual question you still, because you'll be given for PFT, you'll be given for 2024, meaning that you still apply the 2,000 until we get probably to the end of maybe the now 2026. Now you begin to effect what is in the finance bill from 1st July. But most of the question will still go back to 2K altogether. However, you can be asked an emerging question that based on the finance bill for 2025, 2026, what are the changes that were made to the per diem? Per diem, you need to know if it passes through, then that should be 10,000. So then we go to the next. We go to what we call school fee. Number 3 was school fee. School fee paid to employees dependents, school fee paid to employees dependents by the employer, we say on behalf of what you call the employee, on behalf of the employee. What did it depict on this particular area? We say that there are 2 scenarios in this particular area. We have the first scenario where it is taxable, and we have scenario 2 where not taxable. So what did you say in terms of what is that scenario where we tax this? The scenario where we basically tax this. Which scenario do we tax this? Scenario 1, what did you say? Where do you tax? If it was expense, taxed. If it was expensed, we say in the income statement. So we are going to tax. The number 2, we do not tax, not taxable. Yes. If it was number 2, we say if it was disallowed, we don't tax if it was disallowed in what we call in the income statement. If it was disallowed in the income statement. Together, team. These are the building towards those calculations. If we don't understand this, then we cannot build a strong one. We must understand these ones. Are we together? One of the biggest mistakes is not to understand the logic behind this. Then we want to talk about number 4. Can you see this medical? We call it medical benefit. We call it the medical benefit. That was number 4. We call it the medical benefit. I hope you can see that on the board. Medical benefit. Can you see it clearly on the board? I hope you can. So we say that for medical benefit, this is where employer, we say pays for the medical bills, pays for the medical bill. Employer basically pays for the medical bill. And for medical benefit for employees, pay for the medical of employees, and what we call in their dependents, and what we call their dependents. Dependents could mean the children. Again, under this scenario, we had 2 concepts on this together. Under this scenario, we basically had 2 concepts on this. We had the first concept, we say taxable, and we have a scenario where not taxable. When do we tax? When do we tax? Yes, we say it is discriminatory. When the medical bill, we say where the medical bill is what we call discriminatory, paid to a fee, paid to what we call a few employees, paid to what we call a few employees, paid to a few employees. In an examination scenario, in most time in memorial, how has this question been coming? So the examiner will tell you it was paid to senior manager, to all senior manager. The word to all senior manager, that basically means that is discriminatory. If the medical bill is basically discriminatory, then it's taxable, meaning it's subjected to tax together. Matsura, if it's paid to a few employees, the examiner may present it. Most cases, they say that paid to all senior managers. When you just say he has all senior managers, that means that it is discriminatory. In that case, then therefore you tax. The second scenario where it's not taxable is what we call non-discriminatory. Non-discriminatory, we say provided. This means that provided, a scheme that is provided to all, we say to all employees. There's no word all senior, but to all employees. If it's basically provided to all employees, then do not tax together. Do not tax together. We respond with yes. Perfect, Galma. Then we go to what's called employees contribution on behalf of employee. We have it employees, employers contribution. We say on behalf on behalf of what we call employee, on behalf of employees, to what we call to a pension scheme, to a pension scheme. What is a pension scheme? A pension scheme is employer's contribution on behalf of employees to a pension scheme. What is a pension scheme? When you say a pension scheme, what do you mean? Pension scheme is a provident fund or retirement fund, or we call it to a provident fund. So there's a concept in this. The concept, basically, when you talk about pension schemes or provident fund, the two concepts. Number one, there is what we call a registered pension scheme. Example of a registered pension scheme. Example of a registered pension scheme. What is example of a registered pension scheme? NSSF is a registered pension scheme. Is a registered pension scheme. So when basically an employee is contributing on behalf of employee to what we call a registered pension scheme, then that is not tax altogether. That is exempted from tax altogether. If the pension scheme is registered, e.g. NSSF, in that case, then that is a tax exempt together. Are we together? Are we together? Perfect. However, if employee is contributing on behalf of the employee and the scheme is not registered, then that is taxable. If the scheme is not registered, then we are going to tax it together. Taxable if the scheme, number one, you say that taxable. We say if the scheme, that is the pension scheme, if the scheme is not registered. So it's going to be taxable if the scheme is not registered. It's going to be taxable if the scheme is not registered. Then you say tax exempt if the scheme is registered. Tax if the scheme is registered. If the scheme is basically registered together. I hope that is at home. So then we go to what we call insurance. That should be number 6, insurance benefit. We go to what we call the insurance benefit. Insurance benefit. Insurance benefit. What we call the insurance benefit. We go to what we call the insurance. That should be about insurance benefit. So what is insurance benefit? Number one. So when you talk about insurance benefit, this is where employer pays for life insurance or education cover for employees and dependents. What happens when you have your boss, who is your employer, basically paying for you your insurance, your life insurance cover or education cover? How would you treat it? Is it a taxable benefit? Joy, is it a taxable benefit? Is it a taxable benefit? Yes, yes, it is a taxable benefit. If your employer is paying for you your education or your life cover, then that should be a taxable benefit. In agreement, team, Douglas, Edith, Ryle, Ida, Faith, there's no Faith, Abiba. Yes, that should be a taxable benefit. What about if you're paying for yourself? What if you're paying for yourself? What if you're paying for yourself? Douglas, what if you decide to pay for yourself? Is it a taxable benefit in relation to employment? Is it a taxable? Then that is not a taxable benefit altogether. However, in both scenarios, I'm saying if you're paying it for yourself, then we remember we're talking about employment. Douglas, we are talking about taxation of employment. So if you're paying yourself for yourself, then automatically that's not an employment benefit. Together, Douglas, that's not an employment benefit. However, in both scenarios, as we're going to talk about ahead, are we together? As we are going to talk about this concept ahead, however, if you're contributing to your life cover or education cover, you're entitled to what to call, whether you're contributing for yourself or the employer is contributing for you, you're entitled to what to call an insurance relief altogether. So say this is where employer pays for insurance. This is where the employer, we say that the employer pays for insurance, pays for what you call the insurance, pays for the insurance for the employees, pays for insurance. We can have education for employees, and what you call dependents. So when the employer is doing that, we know that this is a taxable. The word is, this is what you call a taxable. That becomes a taxable benefit. So we subject it to tax. That becomes what you call a taxable benefit. That becomes a taxable benefit. Then you have what you call an employer's contribution. Employer's contribution. Employer's contribution. We call it employer's contribution. On behalf, we say on behalf of employees, on behalf of employee, to a member, to a members club, to a members club. Examples of 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 a members club. Members club is like ISPAC altogether. So for the members clubs, we know that if they relate to the work of the employee, for the members club, we understand that if they relate to the work of the employee, we do not tax, then they're exempted from tax altogether. However, if they do not relate to the work of the employee, what are you going to do? You are going to subject them to tax. Are we together? You are going to subject them to tax if they do not relate to the work of the employee. And this is a common area. This area is tested a lot. Yes, if they relate to the work of employee, you do not tax. However, if those members club do not relate to the work, then you basically tax altogether. It is not taxable. It is not taxable if it is not taxable if the benefit if the members club relate we say to the work of what you call of the employee, relates to the work of the employee. Are we together? E.g., contribution for accountants to ISPAC. For accountant to ISPAC. This members club basically relate to the work of the employee together. Contribution of accountants to ISPAC. Then you have the next, what you call cost of passage. Cost of passage. Cost of passage. What is the passage? Passage. And this question, when you talk about passage, if you look at 2024, that is April 2024. April 2024, this question was tested on passage. So what is the cost of passage? So passage is basically cost of moving. We say from one place to another in the course of employment together. That is what we call a passage, the cost of moving from one place to another in the course of employment together. So when you talk about passage, we say that it is not that we basically have three scenarios where the cost of moving from one place to another in the cost of employment is not taxable. We basically have three scenarios. If there's not these scenarios altogether, then you will tax. So it's not taxable basically under three scenario. So if an employee is a non-citizen, basically implying that this is an expatriate altogether, we don't tax altogether. Number two, if the employee is basically in the country for the sole purpose of serving the employer. If you're in the country for the sole purpose of serving the employer, it basically implies that you don't do other businesses altogether. You're basically there to serve your employer. You're basically there to serve your employer. Then we say that lastly, the whole amount was basically spent on passage together. Those are three scenarios. If we have, we know that the cost of passage will not be taxed. Understood? Is that understood? Perfect, Galma. So say it is not taxable benefit. It is not what they call a taxable. It is not a taxable benefit if it is basically not a taxable benefit if we have one, we have two, and then we have three. If we know that if employee is a non-citizen, if the employee, we know that the employee is what you call is a non-citizen. Is a non-citizen. If the employee is basically a non-citizen, that basically implies an expatriate. To say that the employee is in the Kenya, employee is in Kenya for we say for the sole purpose of serving the employer, for the sole purpose of serving the employer. Then lastly, we say that the whole amount is spent on the passage. The whole amount is basically spent on the passage. The whole amount is basically spent on the passage. The whole amount is basically spent on the passage. Understood? So I want us to proceed to non-cash benefit. I want us to proceed to the non-cash benefit. So proceed to the notes you'll have, don't worry. Just make your short notes and you're having the notes, so don't worry. But as I teach, one of the things that I need is not even the notes. I just need you to pay attention. I just want attention on all this that I'm doing. So then we have what we call the non-cash. We call it the non-cash benefit. The non-cash benefit. When you say non-cash, what does it basically mean? Non-cash benefit. When you talk about non-cash benefit, the non-cash benefit. The non-cash benefit. What do you mean by non-cash benefit? Douglas, what do you mean by the non-cash benefit? So these are benefits that employees get from employer in a non-cash form. Yes, benefits that we say that the employees get from the employer, in what you call in a non-cash form. In a non-cash form. These are basically the benefits that employee gets from employer in a non-cash form. For example, if you're working in a company, that produces goods, you're given goods, that's a non-cash altogether. So then we talk about they are classified. They are classified as follows. So we have the first one, we call it benefit in kind. So what is benefit in kind? First one, we call it the benefit in kind. We just follow. No need, no worry about notes. Just follow and make sure we understand that. Benefit in kind. What is benefit in kind? What is benefit in kind when you talk about benefit in kind? So when you talk about benefit in kind, in form of goods, basically given in form of goods altogether. Given in form of goods, we can talk about this is basically given in form of goods. So that is a benefit in kind. So given in form of goods, so we can say is in form of goods from the employer. In form of goods, we say in form of goods from what do you call the employer to the employees, in form of goods from the employer to employees, or we can say free transport by employer to employee. For example, free transport from employer to what do you call the employees. Free transport from employer. In relation to tax, how do you go about it? Benefit in kind. How do you go about it? Benefit in kind. How do you basically go about it when you talk about the benefit in kind? How do you go about the benefit in kinds? Benefit in kind, how do you go about it? Benefit in kind, how do you go about it? Benefit in kind, how do you go about it? For it to be exempted, how much is tax if it's above what? And below this is exempted, above this is tax. So benefit in kind as a 2024, we know that we know that benefit in kind, it is taxable if the total value is above taxable. We know that taxable as a 24, it is taxable if that is as a 2024, if the total value is 3,000 per month. If the total value is above, we say is above 3,000 per month or 36,000, that is other 2024, or 36,000 per annum together. Those are values that are used in 2024. If it's above 3,000 per month or 36,000 per month together, team. I want a yes if you're together. But now I want you to understand this because a lot of times students forget. Now, when it comes to this is not as per the per diem, but I'm saying this is as at the 2024, because most of the questions we're going to do for 2024 are we together. So for this, if it's above the whole amount, you don't less the 36 altogether. Let's say, for example, if you're given a free good, a good worth 180, don't less. Are we together? Don't less. Once it's above, you tax. If it's below, you don't tax altogether. 180 is above 36, so you don't. If the value is above, you tax the whole amount. Understood? If the value is above 36, you don't less than 36. Once it's above, you subject the whole amount to tax, because most of the questions you'll have the whole year. As a 2024, you'll use the 1A, the 180 together. Douglas, Edith, Ida Matsura, do you get me? Perfect. I want you to get me. Some people come and say, Molimu said you less. No. Once it's above, you simply tax the whole amount that is above. I want to talk about meals. 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 When you have meals, meals we said meals we were having, meals basically we were having 4,000 for the meals, 4,000 per month, or what? Or 48,000 per annum. These were for the meal. However, the changes that were affected in DEC. That is for the meals altogether. A very common question, meals as of 2017, meals were, the free meals were, we said 4,000 per month or 48,000 per annum. However, with the changes that were affected in December, meals were increased too. The meals were basically increased too in December, but mostly 2024, you'll have most this on a higher. So the meals were basically affected too as a DEC. The meals were increased too, the free meals. Meals were basically increased too. Team meals were basically, if you check that was about 5,000 per month or 60,000 per annum. That is effective from DEC 2024. Effective from DEC 2024. But majority, when you talk about those free meals, they will touch on this because this was affected in December. Together, we respond with a yes. Perfect. So then we go to what we call telephone benefit. We go to what we call telephone benefit. We go to what we call telephone benefit. Don't worry about the notes, just pay attention. The notes will provide as we had provided the topic 1. But normally in class, you notice something about me, I will always be adding something. So you just pick what is added. Sometimes I can give you notes, then I add a few things. What I feel is necessary, I can add a few things. So when you have the notes, on those notes, you just write together. But I'm saying this, you have the notes. When you say telephone benefit, what is a telephone benefit? This is why employer pays together for the telephone bills or gives a free airtime time to employee. Pays for the telephone bills. Employer, we say that the employer pays for the telephone bill, telephone bill of an employee, or gives what you call gives a free airtime, or gives a free airtime, How do we tax this? So for the telephone, we say that for the telephone, we say we say that 30%, we call it 30% of the benefit. If the bill was 100,000, we tax 30% of the benefit together. We tax 30% of the benefit together. We respond to the yes if we are there. We tax 30% of the benefit. However, some of the things that you need to pay attention on so that you don't trash on. For example, especially where this I'm informed by particularly the last sitting. Why does this inform me? It basically, particularly when an employee was provided, when you are provided a house with a house by the employer, and in that house there was a telephone, and later on you move to your own house. What happens? Later on you move to your own house, what does it mean? You will not be entitled to what? You're not going to be entitled to the telephone bill because you are given a telephone in that house. When you move, if that telephone is not going to be there, so you have to be very keen on that. So particularly on such questions, you must be very keen that how much was that bill paid? You need to check on the month. Don't assume the whole year. Particularly when you are put in a house where the employer is paying the bill. When you leave now, does the employer pay the bill? He doesn't pay that bill. So when you're doing those particular questions, you need to check on the month. You need to check on those months altogether. Like that one was particularly, when you looked at how the students performed in that particular question, was basically they did not check the math particular. They did not check the math. So that is what we call the telephone bill, 30%. Then we have what we call the furniture. The next we call it the furniture. We call it furniture benefit. Furniture benefit. We have the next, we call it furniture benefit. So what is a furniture benefit? When you say furniture benefit, what is a furniture benefit? What is a furniture benefit? What is a furniture benefit? So what is a furniture benefit? So furniture benefit is where employer gives furniture. We know that the employer we say gives furniture. Employer gives furniture. We say that the employer basically gives furniture. The employer gives furniture. We say that the employer gives furniture, gives the furniture. The employer gives the furniture to employee, to the employees, to the employee. In most cases, this question is normally tied to which benefit? In most of the scenarios, normally tied to the housing benefit, where you're provided with the house, but at the same time in that house, you will also be given a furniture. Are we together? Most of the time, you find this question is tied, but you're saying this is where employer gives furniture to employee. Are we together? Gives furniture. Then say that furniture benefit. Furniture. We have it furniture. Furniture benefit. Benefit is taxed. We say it's taxed as follows. It's basically taxed as follows. This one you also have to be very keen. For example, you're provided furniture and you move out of that house. Maybe you have built your own house, then therefore that furniture will not be there. So you say it's 1%, 1% times number of months, times the number of months, then times what you call the cost of what you call the furniture. This is how we get the furniture benefit. 1% times the number of months times the cost of furniture. 1% times the number of months times the cost of the furniture together, times the cost of what you call the furniture together, times the cost of the furniture. So then we have what we call a servant. That will before we call it servant, we call it the servant benefit. We call it the first servant benefit. So when you talk about servant benefit, this is where employer basically has provided you probably the driver with the chef. He has provided you the gardener. That is what we call a servant benefit. And indeed, in taxation, when you're provided and the employer is paying, then that is a taxable benefit. It needs to be taxed. So say this is where we say this is where the employer, we know that where the employer provides, where the employer basically provides what we call servants, provides servant. This is where the employer provides servant. We say that the employer provides servant to employees, or pay. We say pay or pay or pay. We say pay for the servant or pay for the servant or pay for what you call for the servant or pay for the servant. It's say e.g. we have a cook, driver. We can have a gardener, etc. or a gardener, etc. together. So we need to understand that this is what we call this is a taxable benefit. This is what we call a taxable. The taxable amount, we know that the taxable amount is determined as follows. The taxable amount is determined as follows. The taxable amount is basically determined as follows. So we have two components. There's a cost to the employer, cost to the employer, and then we have what's called the market value. So we say that the taxable amount will be, if this is A, this is B, is the higher of two. The higher of two. So you look at that. Are you seeing that? So the taxable amount, you are going to check the cost that is to the employer and you compare with the market value. However, for these particular questions, we don't normally have what we call the cost. In market value is not always provided. So you simply get the cost to the employer. At that assumption, the cost of the market is zero. Are we taking them? But from this, we can begin to see the character of the taxman. Which character are you seeing about the taxman here? Remember, this should be subject to tax. The taxman is now telling us that if you compare the cost to the employer and the market value, what are you taxing? You're taxing the higher. Are we together? And we're also going to see the character of the taxman when it comes to areas that the taxpayer needs to less what the taxman does. And we'll see whether they are fair or unfair. So then we have what we call electricity. The next we have what we call electricity and water benefit. We have what we call electricity, and what we call water benefit. Electricity and water benefit. What we call the electricity and water benefit. So this is where employer pays for water. This is where we say that the employer pays for water, We know that pays for water, and what we call electricity, pays for water and electricity for the employee. I want us to open the tax table, the present tax paper. I want us to open the tax table. There's a link that I gave towards the present tax table. Do you have the present tax table? I want us to open the tax table. Open that tax table using the link. I shared the link to all purpose, where you can get the all purpose. Do you have that link? Ryle, can you forward that link? I think the others were not there. The link to all the papers where you can get all the papers. Ryle, is that link was shared, I think, by Caroline? Can you share it? Can you share that link kindly? The link to that to the papers. So can you share that link? So we say that for electricity, if you look at electricity, we have cost to the employer. You compare with the commissioner's rate. You compare with the commissioner's rate and you pick the higher. Water, we have the cost to the employer. You compare with what's called the commissioner's rate, and you pick the commissioner's rate, and then you pick the higher of the two together. And I want us to have the tax tables. If you have the tax table, we'll be on it. We'll look at electricity first. If you have the tax table, we can look at the electricity first. So do we have the tax table? And the essence of the tax table is basically, this is provided to get the commissioner's rate, Do you have that link? Let me send that link to the papers. Somebody should have sent it link to the papers. The link to the papers. The link to the papers. I think it was sent. Let me just forward it again. Just a minute. Check that. Are you able to see that link? Confirm if you have the link. Confirm if you have the link. Very fast, we confirm the link kindly. So you can check. So that link, you can get variety of papers on it. But I want us to check, that has not changed a lot. Yes, I want us to check now on those rates that are provided, on those rates. So we can click on electricity. On electricity, we just start with electricity, electricity, electricity. So for electricity, we can say cost. This is basically for communal or generator, communal or generator. So from the communal or generator, we can say cost to the employer. Are you seeing down there? Down after the table of investment allowance. Are you able to see down there after the table, communal prescribed benefit rates? Electricity, are you able to see it? Perfect if you are able to see it. So it's saying cost to the employer. We know that for communal, we have 1,500 per month, stock 18,000. We have 18,000 per annum. So you pick the higher. However, sometimes the examiner can bring agricultural. When say agricultural, now for the agricultural, look at agricultural, that is agricultural employees, agricultural employees. For the agricultural employees, we'll basically have, we say cost. Agricultural employees is subsidized to cost to the employer. Cost to the employer. We compare with, we have commissioner's rate, and the commissioner's rate is 9,900 per month or 10,800 per annum. You pick the higher. So we can have the water. If the question is told for working for financial organization, we'll use the communal, we don't, but when they talk about agricultural, use the subsidies. So for water, we know that water cost, water we have first, that should be communal or from borehole. Communal, stock borehole. So borehole, we know that cost to the employer, we have the cost to the employer. So we compare with the commissioner's rate. Commissioner's rate. And the commissioner's rate, we have 500 per month or 6,000 per annum. So you pick the higher of the two. So agricultural employees, when you have agricultural that is subsidized, agricultural employees, is the reduced rates of benefits. So we say cost to the employer. So we have it there. You compare with the commissioner's rate, which you have as 200 per month or 2,400 per annum together. Have we been able to see that from the paper? Have we been able to see that from the paper? Have we been able to see that from the paper? We responded yes if we've been able to see that. Perfect. So then I want to move to motor vehicle benefit, to what they call the motor vehicle benefit. Motor vehicle benefit. Motor vehicle, motor vehicle benefit. Motor vehicle, what they call the car, what they call the motor vehicle benefit. What they call the motor vehicle benefit. What they call the motor vehicle benefit. So when you talk about the motor vehicle benefit, we're simply implying that this is where employer provides a car to the employee for what we call private use. Are we together? This is where the employer, we say provides motor vehicle, provides what we call the motor vehicle to the employees, we say for the private use, And I want you to be very keen on some of the things that I put here. So we say we have a number of scenarios, but say it is taxed. We say it is taxed as follows. It is basically taxed as follows. How do we tax that? So you say 2%, you say 2% times months, times what you call, mark the word, initial value of the motor vehicle. Initial value of the motor vehicle. You compare with what you call motor vehicle CC. So if you compare these two, you pick the higher. So mark the words that I want you to pick. This is initial. Are we together? What is the difference between when now I say net book value? What is the difference between initial cost? Cost is, or just say cost. Cost is basically the initial value. What about net book value? When you say net book value, what does it mean? Less depreciation. But in this formula, I'm very clear and saying that if I'm looking for the motor vehicle benefit, I will say 2% times month, the number of months. So you check that month. If the motor vehicle was provided on 1st July, it means that from July to December, which is basically a 6 months. Are we together? Which is basically 6 months. 6 months together. But you're saying that we multiply by what you call the initial cost, not the net book value. In some portions, examiner will give you the net book value, let's say, to net book value, let's say 1.4. The examiner can give you the net book value to be 1.4, and told you that this motor vehicle are depreciated with the value of 600. So as a good student, what do you do? In fact, in tax, we do not have depreciation. In tax, we have investment allowance. But even if at all, you know that this is a non-allowable. So you add it back. You'll basically add it back to get the initial value, which basically, if you have such a thing, it means that the initial value should be 2 million. Should be 2 million. Are we together? The initial value should basically be 2 million. So the key thing, if the examiner there's an initial value and there's a net book value, understand that you need to use the initial value. And you're supposed to compare with what you call the motor vehicle CC. Motor vehicle CC inamaanisha cubic capacity. I want us to go to this past paper. We look at on the table, on the right side of the table. That will always be provided. Prescribed benefits for rates for the motor vehicle. Are you seeing that in the paper? Prescribed benefit rates of motor vehicle. Are you seeing that? Prescribed benefit rates for the motor vehicle. Do we have them? So for the prescribed benefit for the motor vehicle, so look up, and I want to teach you maybe they're just small things that people forget. So the first category is a saloon cars. We have the hatchbacks, and then we have what we call the estates altogether. So we've been told that if the capacity is less than 1,200 cc per month is how much? Is 3,600. The whole year is 43. So you'll check that motor vehicle. If you're provided with CC, you need to know where the CC from. And you're being told that between 1201 to 1500 cc, which is the cubic capacity, it is 4,200 per month. Then annually, that is 50. Then we have 1501 to 1750. We have 5,800. We have the 5,800. We have the 5,800. We have the 5,800. We have the 5,800. And annually, we have 69,600. Then you have between what we call 1751 to 2,000. We have 7,200 per month. Then we have 86,400 per annum. We have 86,400 per annum. Then between 2,000 cubic capacity, that is 2,000 to 3,000 per month is 8,600. Then per annum is 103,200. Then when you have a saloon car, hatchbacks or estate, that is over 3,000, we are basically saying that per month is 14,400, per annum is 172,800. Understood? Is that understood? Are we able to compare? That's now the cubic capacity. You'll be given the capacity of the motor vehicle together. Perfect idea. So then we have the second category. These are special cases. Sometimes if you're told motor vehicle and there's no description of a motor vehicle, you use the table that I've talked about. I've said if you are told motor vehicle, don't use any, you'll just use whatever is up there. But sometimes the examiner wants to be very, very specific. He'll tell you pickup, the motor vehicle is the pickup. If it's a pickup or panel vans, that is unconverted, are we together? You'll use the second number 2. So number 2, we only have 2 categories. We have up to 1750 cc, which you know per month is 3,600, per annum is 43. When the pickups is over 1750 cc, we know that per month is 4,200, and annually that should be 5,400. But that is when examiner is very clear and says pickups and panel vans. If it says pickup, you'll use the middle. Together, team, we respond with the yes. We respond with the yes. Then lastly, we have Land Rovers and Land Cruisers. When you look at the Land Rovers and Land Cruisers, are we together? We say 7,000. That is just providing 7,200 per month and 86,400. That is for Land Rovers and Cruisers. That is where they fall. That is when examiner tells you this motor vehicle was a Land Rover or Land Cruiser. It will basically be there. But most questions, the examiner will tell you motor vehicle is provided with the car. If you're told, to me, I adjure, use the one that is up. Use the one that is up. If it says motor vehicle, use whatever is up here. But again, of concern, check the month. Check always the month. Check the month. Don't assume it's 1 year. Always look at this. Because you find that you can have those, but just check the month. If the motor vehicle is provided on 1st July, 1st July to December, that's about 6 months. That is about 6 months together. So check the month. Don't assume that is the whole year. So if the motor vehicle, this was provided on 1st July to December, that means you will use the 6 months. If it's the whole year, now you're going to use 12 altogether. Even this one is going to be affected. Don't assume the whole year. Even if this is 6 months and it was below 1200 cc, you're going to use 36 times, now 6 months. 6 months, you don't say 40, 43. And you look at the two and you pick the higher together. So you compare CC with 2% times the number of months times the motor vehicle benefit. You compare those two and pick the higher. I want to talk about the second scenario. The second scenario. The second scenario. So the second scenario is saying that if the motor vehicle is hired, stroke leased from the third party, if the motor vehicle, the first scenario, the motor vehicle is owned by the company or owned by the employer. Together team, that is the first scenario where you use this formula. The motor vehicle is essentially owned by the employer. So the second scenario, we're saying that if the motor vehicle, we say that if the motor vehicle MV is leased, we say is leased stroke hired from the third party, if the motor vehicle is basically leased or hired from third party, we ignore the formula. We ignore the formula and use what? Use the lease stroke what we call the hiring value. We ignore the formula and use the lease stroke what we call the hiring value together. So if the motor vehicle is essentially hired or leased from the third party, what happens is that now we are not going to use this formula, but you're going to use the lease value. So in that scenario, be told that this motor vehicle was gotten from Better Light Company, and they were paying how much per month? They were paying 20,000 per month. The motor vehicle was hired from Better Light, another company, maybe let's say Better Light Company. So what is the motor vehicle benefit if it was the whole year? We don't use this formula. We just simply say the lease value is 20,000 per month times 12, and we get to 40, but we don't apply that formula. So if the motor vehicle is leased or hired from third party, we use the lease value of the hiring value. We ignore the formula together. We ignore the formula. So we don't use the formula together. Then the last one, this has not been tested for quite some time. However, this can be tested. This has not been tested for quite a longer time. So that is NB. NB, if the motor vehicle is partly used for if the motor vehicle is partly used for private purpose, partly used for what you call the private purpose, partly used for the private purpose, and partly used for what you call for official duty, for official duty, and partly used for what you call the official duty. The amount taxable, we say that the amount taxable is the portion, is what you call the portion for what you call for the private use. The portion for the private use, the part that is taxable is basically the one that is for the private use, The portion that is basically taxable is the portion that is for the private use, together. The portion that is basically taxable is the one that is for the private use. But this is where it has been apportioned. So you can be apportioned, for example, you're told official is 40%, then private is 60%, 60%. Tuko pamoja. Are we there? And this is 40%, this is 60%. So the portion that we are saying is taxable is the private. So if I had this formula, if I had my formula here, 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 I'll simply say the portion that you're going to use, this is when you're given the portion. So on this formula, I will say 60% because, and this one I will also multiply by 60%. So because you're saying that the portion that is taxable is the one that is private, together. Are we together, team? If you're together, we give a yes. Perfect. We can have our small break. Amma, you don't need a break? Can we have our small break? Perfect, Alan. Yes, we can have our small break. It's okay. Are we there? If you're there, we respond with a yes. If you're there, we respond with a yes. Are we there? Perfect, if you're there. So I want us to pick on the next, that is what you call the housing benefit. That is what you call the housing benefit. Housing benefit. Housing benefit. Housing benefit. Housing benefit. Housing benefit. So housing benefit. So what is an housing benefit? When we talk about housing benefit. Housing benefit. Housing benefit. So what is a housing benefit? So we know that housing benefit is where we understand that housing benefit is where employer provides a house to the employee, stock accommodation to the employees. This is where, we say this is where, what do you call the employer? Employer provides what do you call a house to what you call accommodation, stock accommodation to the employees, to the employees. But basically, when you talk about this, we know that employees are basically classified into 3 categories. What are these categories? What are these categories? So we have those categories. We have what you call ordinary employees. So what they call the all-time service directors. Together. And number 2, the reason why we're doing that, because it's a question when you look at ATD and CAMS. However, for the PFT, these questions are presented in terms of a question. But when you have the ATD students, because we have CAMS and I think probably ATD, so you can be asked category. Those are ordinary employees to all-time service directors. We have what's called the agricultural. We call them the agricultural employees. Then you have what you call directors. What you call the directors? Directors other than what you call the whole time, other than the whole time service directors. So this is for CAMS ATT. You can be asked categories of employees in relation to what you call housing allowance together. Those are the categories together. We'll respond with a yes. Perfect, Calvin. So then we start with now this ordinary employees, so what they call the all-time service directors. So these ones do not hold more than 5% of the share capital. They do not hold more than 5% of the share capital. They don't hold more than 5% of the share capital altogether. They do not hold what they call more than 5% of the share capital altogether. So how do you get the housing benefit for them? Housing benefit, how do you get the housing benefit for these employees? Housing benefit. So housing benefit for this category should be 15. We say 15% of employment income. We compare with what? 15% of employment income we compare with the market value, so the rent paid. We compare with the market value, so what we call the rent paid. And then you check the higher of the two. Are we there? Then in some question, there is a contribution that employees make. So you less own contribution, what they call the own contribution towards the rent. Own contribution towards the rent. So say that ordinary employees of all-time service directors, they do not control more than 5% of the share capital. How do you get the housing benefit? That is 15% of the employment income. You compare with the market values of the rent paid. Then you less, if they're contributing to the rent, you less what you call the rent paid together. Rent paid together. So then we have the second category, which is agricultural. We call it the agricultural employees. What you call the agricultural employees. So these ones work in a plantation, work in what you call a plantation. And they provided the house inside the plantation together. I want us to respond to the yes if you're there. Are we together? Perfect. So for this ones, we say that the housing benefit, we say this one is 10% of employment income. You compare with the market value. So the rent paid, then you less what you call, you pick the higher, then you say own contribution towards rent. To get on this own contribution, we now use 10% for agriculture. Are we together? We respond with a yes if we are together. What about if the house is provided? NB. We say that if a very common question comes in the TD, if the house is provided, say provided outside the plantation. If the house is provided outside the plantation, we say we use what? What do we use if the house is provided outside the plantation? What do we use? We use 15%. 15% instead of 10%. Are we together? If the house is provided outside the plantation, we use what we call 15% instead of 10% together. Instead of 10% together. We respond with a yes. Are we together? Perfect, Awiko. Then we have directors, other than, call them other than, whole time, all time service directors, directors. So when you talk about directors other than all-time service directors, they control more than 5% of the share capital. So how do we get the housing benefit? Housing benefit, that should be 15%. Now we say 15% of what we call the total income. We get 15% of the total income, 15% of the total income. You compare with the market rate of the rent paid, then you less own contribution. We call it the own contribution towards rent. We have what we call own contribution towards rent. So the question is, what is total income? Total income will be the employment income and other sources of taxable income. So when you say total income, that will basically imply employment income. We say plus other sources that are taxable. We have the rent income, plus the farming income, plus royalty income, etc. That is what we call total income. Those are employees that own more than 5% of the share capital. However, the very common that they use is this. This is mostly those question employees, those are ordinary. They don't own more than 5% together. But if you have directors other than the whole time service directors, this is how you're going to get the housing benefit. We'll respond with a yes if you're together. We'll respond with a yes if we are together. So I want to talk about circumstances though, where housing benefit is not taxable. Circumstances where housing benefit is not taxable. What are these circumstances where housing benefit will not be taxable? Circumstances where housing benefits will not be taxable. What are those circumstances where we have housing benefit not being taxable? Circumstances where housing benefit, where the housing benefit is not taxable, Circumstances where housing benefit is not taxable. Circumstances where housing benefit is basically not taxable. Circumstances where housing benefit is not basically taxable. Where are those circumstances where housing benefit is not taxable? So we basically have three scenarios. Number one scenario is where if it is a necessity. Necessity basically means for the proper performance of one's work, for example, caretaker of a building. So say it is a necessity. One, it is what we call a necessity. It is a necessity that is for what we call proper performance, performance of what we call one's work. E.g., caretaker of a building, e.g. caretaker of a building, So in this case, it is not taxable together because it is a necessity. Together. Are we together? So the second reason is for security purpose. We call it for security. Purpose. This is especially for those who work in the war-prone areas. This is particularly for employees working in war-prone areas. We say for employees working in what you call a war-prone areas. War-prone areas. For employees that basically work in what you call a war-prone areas. For the employees that basically work in a war-prone areas. And then lastly, we talk about for proper performance of one's duty. For proper, we call it for proper performance of what you call of one's duty. For proper performance of one's duty. For example, like the nurses, nurses, we have the matrons, or like for better or proper performance of duty. Nurses, and we can have the nurses. If you have a cook or the matrons, they need the houses for that together. So that is for proper performance of one's duty. For proper performance of one's duty. Then we can talk about the next. We can have the next, that is what we call low interest benefit. So the French benefit. The next one we'll start with in the next class. That is the low interest. What is it called? The low interest benefit. Benefits to what we call the French benefit. This is where we start. In the next class, we should be done. So meaning that in the next class, we should be starting on those calculations. In the next class, we should be able to be done with this, what we have. So in the next class, we'll start touching on those questions. But now the questions for tax, I tell you, I want to encourage people for tax. This question, you should get everything, 90% of the entries. You should be able to get 90% of the entries. What I told you we need to work on, and that is where students don't do well, is the public finance. I have no issue with this calculation. I repeat it again. Where I always ground my students a lot is the public finance, because that is where students fail. And that public finance account for about 30 to 35%. So that public finance in the mid of this month, every Saturday at 5 in the morning, we start. It's for our benefit. So please, when you start to talk about the county's introduction to public finance, relationship between the national government and the county, oversight, we talk about procurement in public sector, public-private partnership, and debt management. Those areas, students don't read them. And so if we take advantage, we should be having a student who scores 95% in this class. Yes. So, and that is what we need. Are we together? That is what we need. The chapter 12 of the Constitution, yes. We should be having a student who scores 95 in this. So we stop it at that point. I want to wish you well. And thank you a lot for your cooperation. This is an amazing class. I must say this is a very good class. We continue with that tempo. We have already overcome. Yes. Is there anybody with a question before I give my closing remarks? Douglas, do you have something? Ida, Ryle, Joy, thank you. Asante Alan. No, DM, Zipporah? Thank you, DM. Zipporah, are you okay? Yeah, that would be okay. And there are easy questions. I don't expect. With this, when you understand this, it flows. You have a question, Zipporah? Zipporah, do you have a question? You are sorted. Does yes mean you have a question or you're okay? Zipporah, you've given me yes. So I'm asking, no questions. Perfect. So we continue to plead with you. Support us kindly. When you hear focus, you're the guys to carry our name outside there. Continue to support us. Our goal is to make focus grow, and above everything is to see focus bring better accountants in the market, not on the mid. So we'll be having to mid of the month. Douglas, mid of the month. I will be doing morning class for the public finance. I will introduce that mid of this month. We have just started mid. I've said mid of the month. Yes. Public finance is very interesting. So very interesting. So we brace ourselves for it. So also support focus. Kindly support us. When you hear there's a student who needs a college, I hope you're happy about focus. I hope as a market the focus in class, you're also happy. Talk to others. When you hear students who needs a college to be in, don't hesitate to recommend focus. God bless you and God bless our class. Thank you so much. Ida will talk about that. I will talk to you personally. I'll see how we incorporate you. The good thing is that we have a video. Ida, the good thing is that we have videos. So that if you miss anything, and Mwalimu is also, those who know me, you can always contact me. If you ask me something on my number, tell me, Mwalimu, can you explain to me this? I will always, because that's the role of a teacher, to be there for the students. Yes. Anytime you miss a class, and we have done something and you don't understand, please give me a call. If at all you need me to explain for you further, this is my number. You just give me a call and we will CPO Dongo. But I've interacted with most of you in this class. Most of you in this class have interacted, so you know me. If you give me a call, I will talk to you and I will explain to you what you need. So don't hesitate. And when you get to assignment, I have some assignment that is still filing for some people. I'll do something. Yes, thank you. We close it there.